Good evening and welcome back to Night Markets. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. So once again, the major theme for the week was the divergences in some of the sectors. The major indices finished the week on another positive note as both the S&P 500 and the Nasdaq Composite reached new all-time highs. But for the second week in a row, the number of stocks that actually advanced was incredibly limited. When one looks at the equal-weighted version of the S&P 500, once again it underperformed its market cap-weighted counterpart by another 215 basis points. So before we get into any of the details surrounding the markets, let's just have a look at the current situation in the Middle East. Over the weekend, the growing concerns were about the potential for Israel to actually involve the US in a conflict in Lebanon. This comes as tensions around Israel's northern border rose and attacks on Hezbollah intensified. Some U.S. officials indicated that the Biden administration perceives the escalating strike by Israel's military on southern Lebanon as a potential indication of a much larger scale invasion and an impending war, which would obviously drag Iran into the picture as well. As expected, oil prices shot up on Monday morning due to this uncertainty. So as always, starting off with the US, we saw some reassuring inflation data and falling interest rates. Both of these contributed to the outperformance of growth shares during the week. According to the Labor Department report on Wednesday, there was also no change in headline consumer price index inflation in May. This marked the first time that this has actually happened in almost 2 years. Core prices, which excludes the more volatile food and energy, did increase by 0.2%, but it was slightly lower than the market anticipated, and this has actually reached a 7-month low. Core inflation also dropped to 3.4% on a year-over-year basis. This actually marked the lowest level since April 2022, but is still significantly above the Fed's target level of 2%. So in addition to some of the positive news on the inflation front, we also saw an unexpected increase in weekly and continuing jobless claims. This has actually sparked concern around the overall state of the US economy. So for the week ending 8 June, approximately 242,000 Americans filed for unemployment, and this is actually the highest number we saw in nearly a year. So despite the downward trending inflation data, it seemed to have had a minimal effect on the Federal Reserve policymakers who wrapped up their scheduled policy meeting on Wednesday. After the meeting, the Federal Reserve published its quarterly summary of economic projections from the individual members. Despite the steady median growth expectations, there's been a slight increase in the projection for core personal consumption expenditure, which is considered the Fed's preferred measure of inflation. For the year 2024, the new forecast actually now shows a rise from 2.6 to 2.8. And despite the Fed actually having seen the inflation numbers prior to the meeting, they still decided to keep interest rate unchanged. However, the big thing was that there was a notable change in the officials' outlook for the Fed's fund rate by the end of 2024. Median expectations rose significantly from 4.6% to 5.1%, suggesting that the possibility of only one rate cut later this year is actually very probable. So the unexpected weaknesses in the labor market and inflation surprises actually caused a significant drop in the yield on the benchmark 10-year US Treasury notes for the week, falling from 4.43% in the previous week to 4.21%. Moving across the pond, European markets began the week on a very uncertain footing due to political risk. This was triggered by French President Emmanuel Macron's announcement of a snap legislative election in June, following the European Union's elections, which revealed a significant shift toward the right-wing and far-right parties. Despite comments from European Central Bank President Christine Lagarde indicating that, restrictive monetary policy in Europe is ongoing and that further rate cuts in the near future were probably not necessary, the overall sentiment remained unchanged. The European bond markets were significantly impacted by all of the unpredictability around the political climate. Government bonds experienced a significant decline at the beginning of the week as the yields on the 10-year in the French and Spanish bonds in particular reached their peak for the year. So just looking at the market performances in the European area, the Pan-European Stocks 600 index returned minus 2.39% as political uncertainty undermined the confidence following the strong showing by the far-right parties in the European parliamentary elections the previous weekend. Hence, none of the major European bourses actually avoided this fallout. Interesting to note, banks in France bore the brunt of the sell-off, ending down almost 8% for the week, and the France CAC 40 shed 6.23% over the week. And then moving further east, Japan's stock markets had a mixed performance for the week. The Nikkei 225 index saw a modest gain of 0.3%, while the broader Topix index experienced a slight decline of 0.3%. The Bank of Japan's June meeting outcome was seen as favoring a more cautious approach, which boosted confidence in the stock market. The yield on the 10-year Japanese government bond dropped to 0.93%, down from 0.98% at the end of the previous week, after it had actually reached more than 1% 2 weeks earlier. During the course of the week, the yen also experienced a decline. It reached a level of approximately 157.5 against the US dollar compared to the level of 156 the previous week. The Bank of Japan decided to maintain the current monetary policy and made the decision to reduce its bond buying purchases. This decision did, however, go against what the market was expecting, as many believed that the central bank would decrease its bond buying purchases this month already. This move was seen as generally cautious, as it confirmed that the process of monetary normalization will likely be slow and steady. On the growth front, revised data also actually indicated that Japan's GDP declined by 1.8% on an annualized basis during the first quarter of the year, which was slightly lower than the initial estimate of 2%. Moving across to China, Chinese equities experienced a decline during a holiday-shortened week, as data indicated that the economy continued to face deflationary pressures. In May, China's consumer price index increased by 0.3% compared to the previous year, which was pretty much in line with expectations and unchanged from the rise observed in April. The core inflation rate, however, which excludes the more volatile food and energy components, increased by 0.6% in May, showing a slight slowdown compared to the 0.7% rise in April. The producer price index experienced a 1.4% decrease compared to the previous year, marking its 20 consecutive month of decline. This decline was, however, less severe than the 2.5% drop we observed in April. So despite various efforts from Beijing over the last number of months to boost the economy and markets, prices in China have pretty much remained stagnant due to low consumer confidence, as well as the continued downturn in the property sector. So bringing it back home, on the local front, South Africa's President Cyril Ramaphosa secured his re-election following an agreement between the ANC and the more business-friendly opposition parties on power sharing. Ramaphosa managed to secure 283 votes from members of the National Assembly on Friday night. So various political parties, including the Democratic Alliance and the Inkatha Freedom Party, have expressed their support for the current incumbent's bid for another 5-year term. As part of this agreement, these parties will be given cabinet posts and important roles in the legislature. And as the ANC put forward the idea of a government of national unity, it did face opposition from former President Jacob Zuma's MK party, as well as the leftist EFF. And consequently, the DA, IFP, and some other smaller parties have now become members of this alliance. So all of these developments in general were positive for South African equities. The all-share index experienced a 0.9% increase on Friday after the establishment of the broad alliance, while the rand also saw a significant gain of up to 0.7%, reaching 18 Rand 30 to the US dollar. So just looking at the week ahead, it's going to be a busy one from a macro point of view. Tuesday's retail sales data out of the US for May will be of great interest, just to get a better idea of how well the US consumer is actually holding up. The market expects that there will be a modest increase of 0.3% in retail sales following a surprising lack of growth in April. Wall Street's closely monitoring consumer spending to assess the potential effects of rising interest rates on the economy. Last week, the Federal Reserve reaffirmed its stance on the need for further evidence of declining inflation before actually considering any adjustments in borrowing costs. China is also set to unveil a flood of economic data this week, as investors are eagerly awaiting signs of a strengthening recovery in the world's second largest economy. Of particular concern is the struggling property sector, which continues to cast a shadow over the overall economic outlook. The Bank of England is also scheduled to convene its latest policy setting meeting on Thursday. It's currently expected to disappoint the ruling Conservative Party's aspirations for a pre-July 4 election rate cut. The current market sentiment does, however, suggest that there is a higher likelihood of easing happening later, with approximately a 40% chance of a quarter point move priced in for August and a 70% chance in September. The May inflation data is set to be released in the UK a day before the BOE meeting, and analysts anticipate that the consumer price index will finally reach the bank's 2% target, marking the first time that we've actually seen this number in almost 3 years. And then on Friday, the Eurozone will be releasing the latest set of PMI indices for June. Market watchers are eagerly awaiting these numbers, hoping to find some indications that the economy is actually recovering. And then locally, in a holiday-shortened week, the focus will be on the release of local inflation numbers out on Thursday. Inflation cooled marginally to reach 5.2% last month, with the decline largely attributed to the reduced food prices. So while inflation continues to decline, it does remain above the Reserve Bank's 4.5% midpoint target, which the bank views as the ideal level to actually start cutting interest rates. And then, as always, we'd like to end off with an interesting investment discussion we had during the week. In this case, it's been the Rand. The Rand has obviously traded very volatile over the last number of weeks, reaching all the way up to 19 Rand against the US dollar. Currently trading closer to the 18 Rand level, and should we actually see the Rand breach the 18 Rand level to the downside, this could be very positive for the inflation outlook and hence for any interest rate cuts going forward. Thank you for joining me this evening on Night Markets. My name is Jacobus Brink. Financial markets close at 5 p.m. Night Markets opens at 6 p.m. Let's start the conversation.